Okay, for chapter 6, to start us off, I've chosen 3 problems that we'll do at the same time. Both of them kind of have a similar format in terms of their answers, how they kind of want them written. So since we have enough room on the board, I'm going to do all 3 at once. The first one is M61. M61 says identify the type of business as service, retail merchandiser, wholesale merchandiser, or manufacturer for each of the following. They give you some information. They want to know what type of business is it. The company reports no inventory on its balance sheet. In that instance, we label this as a servicer. Remember that servicers, they provide service, like CPA firms, law firms, medical firms, or medical locations, medical businesses, right? They would provide a service to their client as opposed to providing actual physical goods that they can walk away with, okay? Says 2, the company is a true middleman buying from a manufacturer and selling to other companies. In this instance, we'd have a wholesale merchandiser. Remember that wholesalers, they buy from a manufacturer and then sell it to a retail. They're what we call a B2B operation, a business-to-business seller, okay? They're a business and they sell to other businesses. They don't sell to end consumers for the most part. The next one, the company's inventory includes raw materials that will be processed into ready-to-use goods. This is a manufacturer. Remember we talked about in class, you'll discuss a manufacturer more so in your second accounting course. In fact, almost the entire second accounting course is dedicated to the processes of a manufacturer. But the things that I want you to know about it is simply that a manufacturer makes its own goods, as opposed to a wholesaler who buys it, probably from a manufacturer, a servicer who doesn't have it, and the fourth one is the company sells goods to consumers. This is a retail merchandiser, right? Retail merchandiser probably gets its goods from a wholesale merchandiser who got them from the manufacturer. Retail merchandiser eventually sells to the end consumer, okay? End consumer. All right, M62. N62 says Fox Racing has a system of internal controls with the following procedures. Match the procedure to the corresponding internal control principle. First one, the treasurer signs checks. This is a established responsibility. Remember, when we read this line, it indicates that a certain specific person signs the checks. The treasurer signs the checks. Therefore, meeting the definition of assigning responsibility to a specific person, a specific individual, okay? The next one says the treasurer is not allowed to make bank deposits. In that instance, we have B, segregation of duties, okay? To differentiate between number 1 and number 2, why 1 is A and why 2 is B. If you look at B, it indicates that the treasurer is not allowed to do something specific. As opposed to number 1, it states that the treasurer has a specific role. So number 1 was assign responsibilities or establish responsibilities. The treasurer has a specific responsibility. What is his or her responsibility? Sign the checks. As opposed to number 2, stating that the treasurer can't do something else, a related activity. So they're segregating duties of that related activity. Does that make sense? So this one assigns responsibilities. This one establishes that related activities cannot be done by the same person. That is a separation or a segregation of duties. Okay? 3 says the company's checks are pre-numbered. This would be D. Document procedures. What's the purpose of this? If you pre-number the checks, right, it's real easy when you're looking over the bank account or when you're thumbing through the checks to find out if one is missing, if someone slipped it out, right? If you look at the bank reconciliation and you find that some weird checks aren't missing or they process a check that's $999 when most of the checks that you're writing are in the $300 level, right? Well, you're going to look at that check $999 and say, what the heck is going on, right? That's documenting, okay? Documenting. 4 says unused checks are stored in a vault. This is letter C, restrict access. Restrict access is just how it sounds. You're not allowing someone to gain access to something that they don't need. It can be a physical control, but it also can be something electronic, like restricting access to a computer via a password. Okay? The last one, a bank reconciliation is prepared each month. This is E. Independently verify. Okay? A bank reconciliation would allow someone to review and say, here's what our bank records say, here's what our books or our records say, what's the difference? And they try to identify those differences and make sure nothing fishy is going on or that there's no errors that they need to know about, okay? These are the principles that we talked about as internal control principles in your book. Let's go to the last one. This is M67. M67 says in each situation below there's internal control weaknesses. It asks us to identify what internal control principle is violated. So looking at the first one, letter A, it says the warehouse clerk is responsible for ordering inventory levels when levels become too low and advising the accounting department to issue a payment to the supplier when ordered goods are received. The problem that we have here lies in segregation of duties. In this instance, we give the inventory warehouse clerk the responsibility for ordering inventory levels and then advising the accounting department to issue payment. What should be happening, right? We need someone else involved. We need to segregate duties. When would the inventory clerk or the warehouse clerk advise payment? Supposedly it would be when they receive the goods. But what's the scenario here that could happen where the warehouse clerk could devise a scheme to actually steal money from the company? Well, if they're responsible for ordering more inventory when the levels become low, they could theoretically make up a company, order inventory from them because they have low levels, and then when the inventory came in, they'd advise the accounting department to pay it. When in fact, if they're responsible for both receiving the inventory and also alerting people to buy more inventory, right, they could say the inventory is any level that they want it to be because they're responsible for calculating what the inventory levels are as well as actually ordering more inventory. Does that make sense? So in this instance, we should segregate the duties. One person should be in charge of advising people of when to pay, like the receiving department, right? And then another person in charge of ordering that inventory. Here's a purchase order that comes in, employee A is in charge of that. We receive the goods, employee B is in charge of that. When we match the two together and then compare it to the invoice, then we can send that over to the accounting department, who might prepare the check and then give that to another supervisor or manager who then signs the check. Okay? All right, the next one, B. B says for each purchase, the accountant compares the purchase order prepared by the purchasing manager to the receiving report prepared by the warehouse employees. And let's just stop right there, guys. That right there, where you have the, who do they call it? The purchasing manager responsible for the purchase orders and the warehouse employees responsible for the receiving part. That right there is the segregation of duties that we would have wanted to happen in letter A. But let's keep reading. It says, compares the purchase order to the receiving report and then attaches these documents to the corresponding supplier invoice and files them by supplier name. The accountant then prepares the check, which the owner signs and then sends to the mail clerk for mailing. What's the problem here? In this instance, we don't have enough independent review. There's a couple things that could have happened to make this better. Number one, it says that the accountant compares the purchase order to the receiving report, right? But it does not say that the purchase order and the receiving report is actually compared to the invoice. It simply says that the accountant staples the invoice to it and files it away, right? Instead, the accountant should then be comparing the invoice to the purchase order and the receiving report to make sure that all three match. But one step further that has to take place, it states in the very last line, the owner merely signs and sends to the mail clerk for mailing. The owner who is signing is actually taking responsibility for signing the disbursement, signing us giving away the money, needs to be checking all of those documents as well, right? We talk about in chapter 6 a voucher system. A voucher system ensures that all of these items are properly compared by the person who's supposed to be signing over the checks. Person or persons. Because most of the time you would want more than one person signing the check, especially if it's a check of a sizable amount. And remember, it doesn't matter if you're talking about a physical paper check or an electronic check. Okay? So regardless, the issues that we have in B is that the accountant didn't compare the invoice to the purchase order and the receiving report, and then the owner who's signing the checks didn't look at any of the documents, right? So particularly if there's collusion going on, the owner's going to have a serious problem. Second to last one. C says check signing machine is stored with a supply of blank checks in the lunchroom closet. This one's restricting of access. And this one, is really kind of silly. I hope no business people actually put this into practice. Obviously, you would not want to keep a check signing machine with blank checks in the lunchroom where any employee can have access to it. You need to guard the access. Employees should not have access to anything that they don't need access to. Obviously, most employees would not need access to blank checks. The last one, D, says purchase orders can be approved by the purchasing manager, accountant, or warehouse supervisor, depending on who is least busy. This instance, assigning responsibility. Look how many people that we have listed in this letter. How many people that we have listed that can sign, what is it that they're signing here? Can approve purchase orders, right? Several different people can approve purchase orders. We need to assign responsibility. That way, not one person can point to another person. Now, this may depend a little bit on how the purchase order is actually approved as well. Is it a stamp thing where anyone could grab the stamp and just stamp the purchase order and say it's approved? Then you have a lot of finger pointing going on. That's going to happen to a lesser extent if instead you have someone sign initials, right? But still, someone else could sign someone else's initials, right? Someone else could sign their initials and say that they approved it. And when you have multiple different people actually able to approve, you can get away with signing multiple different people's initials and kind of spread out your fraud scheme so that it's not always geared towards one person. If you make one person responsible, you're much less likely to have a scenario like that happen. Now, in practice, in real life, honestly, there are often multiple people who can approve certain types of things, whether it's a cash disbursement or an invoice payment or a purchase order. But it's usually limited to a specific number of people, and they will describe those in the accounting policies and procedures, okay? All right, this is the problems for M61, 62, 67. If you have any questions, please let me know.